And after we got the short into that sell originally, we obviously lost the value after we'd got the short. So that's that idea of laying off the risk that we finally find somebody else coming to the party and saying, well, it's not as good as it used to look. That's one of the biggest skills you can learn as a trader, because there's this ego that drives a lot of traders. The ego that drives traders is, well, I've started selling it, so I'm just going to keep selling it. I don't really care. Forget about it. The story's changed. It doesn't matter how much work, how much time, how much effort you put into getting that short. Get off it. Wait for the next opportunity. So when the next opportunity set up, when the RBOB got sold again here into 3 o'clock, you're ready to do it all over again. And sure enough, there it is. We've taken out the cap buyers and we've moved the measure. That became the accumulation effectively for that entire move, didn't it? It's almost like we told you that this was what it was going to be. So there's your cap buyer there. There's your top edge there. And this was your target price here. You see it? So we had this idea of the 15, 79.15. We told you about it several times. We told you what the idea was. We told you where the trade was. We told you how it would structure. And there was your measured move target price right there. Is that pretty good outcome? Did it take a lot more work than you thought it was going to be? Of course it did. It took more work. It took more effort to build into that as a bit of positioning, right? Did we suggest it might be the case? Did I not possibly suggest that this might have happened here? Did I not kind of give you an idea that this could be a thing? When we talked about this live in the room as a classroom, did we not already go over this as a possibility, as a real money possibility that this could happen, right? We told you that this was a real money possibility. We told you if this was the capper, it could take a long time, potentially as many as 2 hours. And when you look at the trade here and you say, well, it started at 13.50 and it didn't break structure the cap until 15.20, it's nearly 2 hours wide, isn't it? The trade ends up taking nearly 2 hours to finally break structure low. Well, we said it could take up to 2 hours. For a day trade, 2 hours is about the maximum it normally takes, because if you can't get enough volume in 2 hours, you're doing something wrong, right, on a day trade basis. Because if you get any more volume on a day trade basis than 2 hours provides you with, you're never going to get short of that volume by the end of the day. That's a macro swing for sure. You're going to hold that trade for maybe a week. So when we kind of consider that that's exactly, literally to the letter about what happened next, you can obviously get involved in these yourself. And hopefully, I think by the sounds of it, a few of you did get involved in this. But can you see how you can be left on the sidelines watching everybody else making their money when you should be in it yourself? You're recognizing the storylines. These are incredibly powerful little trade ideas. And even on the micro world, you still see the opportunity to get in later, because we had this candle here. What is this candle called? The 2 sigma candle, right? And even if you were using those ideas of the fair value gap narrative there, it makes no difference. Perfectly valid to see that as the 2 sigma sell trade there. So when the price tested and rejected this price, you get short. With the value developing on the sell side, you get short. And now you're working the sell trade. Take it down to a 1 minute chart, you'll see it crystal clear. Take it down to the 1 minute chart, you can see the short value coming in. You can see this series of trades here as it broke this structure low here. That they're all 2 sigma sells. So this is the top line price there. We talked about this trade when we talked about the interns exercise this morning. And you can see that just selling off of that test, so long as the price doesn't go 79.50 bid, we should be good to go, right? If the price goes 79.50 bid, we're going to be trading above 79.60s. We touched on that this morning, didn't we? Never went 79.50 bid, it stayed 79.50 offered. And because it goes 79.50 offered, we go all the way to measure at 78.70s. Woo-woo! Ring the bloody bell. What a great bit of business, guys. But we had to give it time because it turned. It turned bad on us as we were in a deal. It turned on us as we got involved in the first place. These types of things happen, guys. We just have to be aware that they happen. We've got to be willing and able to take advantage then when they do happen and get away from trades that are wrong. Just get away from them. We don't have to start that one again. We don't have to hang about. We just acknowledge it's changed. We just acknowledge it's gone wrong. Get away from the deal. And that's all we did on oil. It was a great example of it, actually. A really, really, really good example. So hopefully you've learned something from it. If you haven't learned anything for it, we'll go back over it to make sure you do learn it properly. But in future, use this stuff, yeah?